Yeah, thank you so much for the invitation to be here. It's a great privilege coming as a foreigner to attend and also observe some of these extremely interesting discussion. I really have enjoyed it, and I hope you'll enjoy some of my thoughts here as well. Now, my first thought actually is that economists are not that popular for the time being. I think it's not completely reasonable with all the criticism of economists, but they sometimes try to move themselves into other fields, and some economists try to work with psychologists. And there's one interesting result from this kind of research, and that is if you hand out a present for someone of the value of, say, 100,000 euros, and this person goes on with these 100,000 euros for, say, 3 months or 6 months, this person is going to be happier than before. But if you then afterwards take away these 100,000 euros, then you would think that this person is going to be as well off as he was before he received anything. That's not the case. He's going to be much more miserable, much more depressed than what he was before he received this amount of money. That says something about macroeconomics, why it's important to avoid these booms and busts. Now, having driven around in Donegal for the last 3 or 4 days, I can see that at least something came out of all these construction booms. There's an incredible amount of beautiful houses at beautiful locations. I hope they will not be empty to the end of their lifetime. Basically, I'm fairly optimistic on Ireland. I think this is a country, and we have heard that, with very sound structures, flexible labor market, flexible product markets. We have learned that the internal devaluation works. It's hard, but it works. The current count is back in balance, which is not the case for the other very troubled economies. There will never be an easy way out of a crisis like this. I tend to say that there are 3 prerequisites which are needed to get out. You need patience, you need consensus, you need austerity. I'm not completely sure about consensus, but I feel this is a pretty consensual society. I think Ireland has quite a good bunch of each of these recipes needed to get out, and it takes a lot of muddling through. There's no simple way of managing a financial crisis like the one you have had. What I would like to offer you is first an attempt to compare Ireland with my own country. I think I learned quite a bit by doing that, and I think we will learn a bit about it in an international context. There are a lot of similarities, there are also differences, and then I'll turn to the EU issues, which I can believe is interesting for many of you. So first, my main assessment of the Irish case, pretty simple. Sound structural fundamentals and policies, but you also have this infamous procyclicality in your macroeconomic management, which led to trouble, financial sector vulnerabilities, and too much lending, and then you had insufficient buffers. I'll come back to the latter point in a moment. So first, comparing with the Danish case. We actually share a lot of similarities. Countries have just about even size of the economies, and a lot of common history. There's one major difference, and I won't go back to that. We pay quite a bit more taxes in Denmark and the other Nordic countries, and you won't appreciate the level we have if you were to go for it. That makes a big difference, but I don't think that has much to do, if anything, with the trouble we are comparing here. We both had a positive experience of the so-called expansionary fiscal contraction in the 80s, tightening fiscal policy, but managing to get the economy out of a slump by harvesting gains from lower interest rates and a pretty long, solid period afterwards. We managed to get rid of public debt to a very large extent. I think we have flexible labor markets, and we, at least until the crisis, had very low levels of unemployment. On the exchange rate, yes, Ireland is member of the Eurozone, Denmark is not, but just observe that Denmark is a country completely pegging, shattering the euro. So if there's any difference in terms of the two economies, it's not due to the exchange rate system, it is basically the same. I can come back to where I see the differences being in and out, but it's basically the same. Observe also that if we count all 4 Nordic countries, they are very, very different in terms of the exchange rate regime. Very different. Finland is member of the euro. Denmark is pegging the euro. Sweden has a completely fixed floating exchange rate with inflation targeting. Norway has something in between. They have a floating rate, but they tend to target both inflation and the currency at the same time. Not quite sure how they manage to do that, but they try. So they are very different. So don't believe that differences between Ireland and Nordic countries has much to do with the exchange rate system. I don't think that's the case. Now, we also worked out some joint mistakes over the last decade. Maybe I should add that both Denmark and Ireland did very well in the 1990s, got the economy in good shape, managed the macroeconomy well, introduced a lot of structural reform, and we came out of that decade in really good shape. That has not been the case over the last 10 years. And our joint mistakes was first to have too loose financial regulation and supervision. Second, we introduced procyclical changes in the taxation of housing and mortgage interest payments. In the Irish case, I understand you got rid of deductions for interest payments in the late 90s. For some reason, you introduced it again in 2002. I would consider that a prominent policy mistake, contributing to generating housing booms. What we did in Denmark was as bad. We have property taxation, but a fairly large component of that was in 2001 frozen in nominal terms, house by house. And expect what happens in such a situation. You decouple the tax in each house from the real value of the house. So effectively what is happening if the housing market starts booming is that you cut the implicit tax rate, keeping the tax revenue house by house constant. So in addition to creating a lot of distortions in between housing, you also create and expand the bubble even more. And now when house prices are going down, we still keep this nominal tax level, implying that we are implicitly increasing the tax rate. That is also a terrible procyclical way of managing policy. And then procyclical fiscal policy. I'll move forward to one of my slides here. I will not show you all my slides, but I have a particular one here I think is interesting. It's a little bit guesswork on the numbers of islands for the last couple of years, but this is the politically decided changes in the budget balance year by year. And what is interesting is that in boom times you ought to have positive numbers. You ought to tighten fiscal policy in good years. And to avoid the procyclical stance in bad years, you have to loosen up fiscal policy. What you can see is for the last half of the last decade, in the case of Ireland, you loosened up fiscal policy every year, 5 years in a row. The Danish case is not quite as prominent, but we certainly did not run a fiscal policy which was sufficiently tight. But the difference showed up in particular after the crisis, whereas we all know Ireland has had to tighten fiscal policy tremendously. It's a procyclical fiscal tightening, whereas we had room for maneuver to expand fiscal policy in Denmark. And that's probably the main reason why our slump has not been as deep as yours. But the real reason why that was feasible is that if you look and compare the public finance situation, you can see that in the Danish case we had much larger budget surpluses in the last part of that decade. I would even argue that since the Irish housing bubble was much larger than the Danish one, Ireland was supposed to have an even larger budget surplus. I think our budget surplus, which was 4 or 5% of GDP for 3 or 4 years, was not enough. but definitely in the case of Ireland, it was certainly not enough. One has to save in the good years to be able to expand in the bad years. So this is my main point on that. Then I come to the buffer point. I think that might be the main difference between the two cases. Clearly, Ireland has a much larger foreign debt position. It's mostly owned to these large foreign companies which harvest a lot of dividends every year. That's the reason why the GNP is much larger than the GDP, much smaller than the GDP, but that is a weakness in my view. You also had large current account deficits before the crisis. We didn't. I have mentioned the public surplus. If you look to the credit market, the housing market, in the Danish case, this is financed primarily not by banks, but by the mortgage institutions. If there was any recommendation I would give to the Irish financial system, I would recommend looking carefully to the Danish mortgage system. I think it's very valuable. It's solid. It has a lot of safety valves built into it, and I think that has been one main reason why we hadn't had as much trouble as you had. But one of the differences is that the loan-to-value ratio allowed in these institutions when you hand out the money is 80%, and I understand that in Ireland it might be 95, it might be 100, in some cases 110%. And if that's the case, then of course you get an economy which is very sensitive to what will happen if the house prices go down. So these are differences. I think mainly we messed up the 2000s, but Denmark could better afford it because we had these stronger buffers in both the current account, public surplus, and in the banking system. After the crisis, of course, you had a much larger housing bubble. I think we created something like 1/3 or 1/2 of the Irish housing bubble. It was bad enough, but not as bad as the Irish one. And for that reason, you have a bigger recession. It will take a longer time to get out. I mentioned that you got yourself into this procyclical tightening, and you were much more vulnerable in the case of the financial sector. I think these are interesting lessons in themselves in between the two countries. There are some implicit policy recommendations hidden within these comparisons, but it also is warm up to what one can do when discussing the EU and EU issues. And what I should probably mention is that before coming to the Central Bank of Denmark, I've only actually been there for 6 months. Before that, I had a brief spell at the board of the IMF, including where the Irish program was discussed. That was interesting. Before that, I spent quite a few years in the finance ministry working with committees in Brussels, and I'm not proud of it, but I was one of those in charge of examining the stability and convergence programs, including the Irish programs in 2006, 7, 8, 9. I'm happy to share some of the experiences for that, but this is part of my history for coming here. So why did it went wrong with all this EU coordination, even if we did quite a lot of it? We had quite tense discussions. There were quite tense discussions in the Eurogroup, also where I did not take part because my country is not formally member of the Euro area. If I look back to the recommendations given from the EU, I have actually a list, but I won't read it. Given the current trouble of Ireland, and other countries, it's clear that the recommendations given from the EU to these countries before the crisis were definitely too weak. And they were not only weak, they were very centered on one specific issue, namely the current stance on the public budget. And I can tell you, those of us who tried in those days to introduce a wider perspective on fiscal imbalances and economic imbalances. We were hit back pretty hard. What I'm referring to now is not the Irish case, but there are other cases of housing bubbles. And I remember when we ran an examination of such a country, and they fiercely defended themselves and insisted they had a budget surplus, so why would anybody take an interest in their huge current account deficit, in their competitiveness problem and all that? None of your business. Your business is only to take stock of the situation on public finances. I remember after that examination, I told this guy, my friend, you're going to regret this position. I think he has regretted that quite a lot. My point is that the surveillance we did in the EU had a terrible omission, and that was this narrow focus on fiscal imbalances and not taking the wider macroeconomic imbalances into account. If you have a huge current account deficit, it's a very strong signal that your situation is not sustainable. It's not going to last. In addition, if you have a very large competitiveness problem, this is not going to last. It's an indication that somebody overspends, maybe not in the public sector, but if they overspend in the private sector, you can be pretty sure sooner or later they will run out of money, and for that reason you will have a slump. And given that slump, the underlying weakness, what you here have of the public sector, will come to the surface, and you will have a serious problem also with your public balance. One of the things they're trying to correct in the European system now is introducing what they call an excessive imbalance procedure. And that is trying to take stock of such imbalances at an early stage, trying to ensure that countries with such imbalances get harsh recommendations in due course and not until after it's too late. If it works, I don't know. I think it's a step in the right direction. The big trouble is, how do you ever get any politician to accept that it's good times before those times have disappeared? It's simply an inherent stance of a politician that you cannot go to your voters and tell them, friends, we are now having good times, but in 2 years' time you will be much worse off. No politician can promise anything like that. You'll never be elected. So it's inherent in the system that coming up with tough recommendations in good times is just very, very difficult. So my main response to that is normally, hey, if that is so difficult, better try to build some automatic stabilizers into the system so that this works automatically. You have automatic fiscal tightenings, you have automatic provisions, counter-cyclical buffers in the financial sector, so that you don't need politicians to take these terrible decisions in good times because they're not going to do it. So it's tough. Now, the third point is people felt extremely protected by the euro. And yes, they were actually protected by the euro because in the bad old days, remember the early 90s, we had a crisis which is not that different from what we have today, but the euro didn't exist. So instead we had a combination of a financial crisis and a currency crisis in quite a few countries. That was not pleasant, I can tell you, and such things has happened before. So the euro offered protection against currency risk, but markets forgot that the euro does not offer protections against the credit risk. And maybe the markets had an implicit understanding that if you were a member of the euro, you were protected by the joint system and you will always be bailed out. I don't think the latter is really the explanation, because if you look across countries, there are many failed countries in terms of economic policy over the last 10 years, and it's only a bunch of them being part of the euro area. There's a lot of the Baltics, Iceland, the UK. They all made mistakes. They were outside the euro area. So this is not the main reason, but of course the spreads, the risk premium should have been much higher before the crisis. What unfortunately happens with financial markets is that they are very patient for some time. They move in herds, they move with cliff effects. So when they figure out, hey, there's a problem, they all move in the same direction, reinforced by the rating agencies, of course, because they change their rating then, and all investors then invest according to these ratings. And then suddenly you have a huge increase in the spread, no warning, and you are in a deep mess. So after such an overheating, I don't believe there is really any walk in the park. It's a mess. It has to be taken up with the patience and modeling through. I think there are hardship, of course, again, ahead. I don't believe that a flexible exchange rate would have changed that. We got, I think, in the last session, a pretty good explanation of what would happen if anybody tried to leave the Eurozone. I mean, in a democracy, could you sit down and debate and prepare for leaving the Eurozone for months, maybe years, without anybody in the markets observing that and reacting accordingly? Of course, it can't happen. It's impossible. So it's really messy leaving the euro. But if you had flexible exchange rate before the crisis, what would happen? I think what would happen is the market would have reacted probably somewhat earlier. There would have been an appreciation, there would have been currency pressure, spreads would have went up, but it would not have prevented the crisis, as we have seen in so many other countries. And I can tell you for sure, I cannot recommend the exchange rate system my country has as compared to yours. We have this pegged currency, and it's pretty easy to understand what's the difference between a pegged currency, which is completely locked, and being members of the euro. There are only three differences. The one is we pay, or citizens pay, companies pay, cost of exchange. It's not a big cost, but it's annual, and it's some practical cost. There are a couple of other practical costs associated with that. It's pretty irritating if you travel around Europe. You have to have different sorts of money all the time. I tend to mess that up. It's complicated, but it's not a big issue. The second issue is in times of economic trouble, if you're not having the protection of the euro, you get hit by financial markets. And even my pretty robust economy in 2008 got hit by financial markets. I think we were the one and only central bank on the entire planet which in the midst of the crisis in 2008 increased our interest rates and not reduced it. Is that rational economic policy? Of course not. But with a medium-term perspective, and if you have a fixed exchange rate, if you experience some currency pressure, you will have to increase your interest rate. So we did that, which is kind of madness, you would think, when banks are struggling, the economy is taking a big hit. But that has happened. It happened in 2008, it happened in 1993, it happened before, and it happened again. And it's not an economic advantage. What you would do implicitly here is you import the procyclical monetary policy stance in times of crisis, and it's not to be recommended. Now, the third issue is, basically, if you're not a member of the euro area, you import an interest rate, you copy the decisions in Frankfurt, but you're not part of the decision making. So we put all our trust in the central bank governor of Ireland to be better cope with setting our interest rate than we can do ourselves. And you share it, of course, with other euro members, but that's, of course, an omission, and we could also have been part of policy making in Brussels to a larger extent than what we have here. So I don't believe this exchange rate issue is the real one. The real one is if one mismanages one's economy, runs procyclical policies, bad macroeconomic policies, you take a toll, and it's a hard crisis, and it's deep, and it takes a long time, and it has not much to do with the exchange rate. Now, the final point on this is the EU and the IMF can, of course, alleviate the pressure in the sense that I explained this cliff effect, that suddenly the financial markets react. And when that happens, it gets almost impossible to get out. Fortunately, here we have the IMF. Fortunately, we created the European system, which is not providing grants, but which is providing loans at a reasonable interest rate, last week more reasonable than before, and which can help countries through such a difficult time, and it will be easier to get back. Final remark, having listened also to some of the discussions earlier this morning, fiscal union and these issues of fiscal transfers. I agree very much with what one of the speakers said. It's not feasible to have a fiscal union, it's not realistic, and it's not necessary. What we need to care about is the macroeconomic situation, the public budget balance, the underlying balance, current account, inflation, should be all right. But imagine what it will take to have a real fiscal union. How can you persuade taxpayers in any country to pay for decisions worked out in other countries? Let's just take Greece as the most extreme example. If you allow people to go on retirement in their 50s, maybe even early 50s, if you don't collect the taxes which are inscribed in your tax legislation because of some terrible mismanagement of your tax system, how can you expect other taxpayers happily to pay for that through a fiscal transfer? It's just not going to happen. So the implication of a joint fiscal system with fiscal transfers would have to be joint tax rates, joint unemployment benefits, joint pensions, joint pension age, joint health expenditures and all that. And Europe is simply not ready for that. Nobody wished that to happen. What I observe is, even as compared to the 90s, a much weaker push in that direction. There are really no bureaucrats pushing in that direction. So it's not going to happen. And I don't think either it is really necessary. It can be made without it, but it's of course pretty tough. Let me... No, to that, just that, if you think about it, haircuts and default is, in the current context, not that far from being fiscal transfers. If you have a country with loans provided by other governments and you will then see haircut on these loans, that is a fiscal transfer. And that will create a huge political clash in between countries. What is politically realistic is lending across countries. I think it's much less realistic to expect anything like a fiscal transfer, even, of course, there are some borderlines here. Let me stop. Thank you.
Thank you very much.